If I had to look at Visa and Starbucks today from scratch, knowing what I know about this market, this consumer, and the way earnings reactions have been acting lately, I would not start with the headline beat. Most people see a company beat revenue, beat earnings, the stock pops after hours, and they immediately think, okay, that must be bullish. But that is not how this market works anymore. We are in a market where good companies can report good numbers and still get punished, and beaten down names can rally hard if investors see even a small piece of evidence that the story is changing. So today we are going to walk through two very different businesses. One is a global payments machine that sits between buyers and sellers and quietly takes a tiny slice of enormous transaction activity. The other is a consumer brand trying to convince Wall Street that its turnaround is not a nice presentation, but something customers are feeling inside the stores. Today is Wednesday, April 29th, New York time. Comment below what day and date you are watching from because earnings season moves fast, and if you value my content, support this work by subscribing and commenting John A.G. Best. It tells me you want more breakdowns like this. So let's get started. Now, before we get into the two companies, you need to understand the environment these reports landed in. The broader market had been running hot, not just a little bounce. A sharp, impatient move higher. Then suddenly you start seeing red again. That matters because in a tired market, earnings need to do more than clear a low bar. Investors want proof, guidance, margins, and confidence. The next quarter will not fall apart. And if a company cannot give them that, the stock can get hit even after a beat. That is why the first question is not, did Visa and Starbucks beat? The first question is, what did they prove? And that is where this gets interesting. Visa's report was clean on the surface. Based on recently published numbers, revenue came in around $11 billion, up in the high teens from last year. Adjusted earnings landed a little above $3 per share. Payments volume kept growing at a high single-digit pace. Processed transactions also grew in that same zone. Cross-border activity, which tells you about travel, commerce, and international spending, grew in the low double digits. That is not a weak report. That is a machine still running. But here is the part people miss. Visa is not a bank. It is not lending you money and hoping you pay it back. It is a network. It processes, it authorizes, it settles, it connects. So when spending rises, when travel improves, when digital payments replace cash, Visa can benefit without taking the same kind of credit risk that a lender takes. That is why this business has historically received a premium valuation. The model is unusually powerful. But, and this is important, even great businesses can become bad investments if you pay too much or ignore the risks. Visa also announced a large buyback program, roughly $20 billion over multiple years. And normally I like that. I do. If a high-quality company buys back stock when the price is under pressure, that can beat buying only when everyone is euphoric. But a buyback is not magic. If the business is strong and the stock is reasonable, it can create value. If the stock is expensive or if regulation changes the economics, then the buyback is just a financial bandage over a more complicated question. And Visa does have questions. There is still noise around card fees, merchant complaints, legal battles, and regulatory pressure. A federal judge has been reviewing a massive swipe fee settlement between Visa, MasterCard, and merchants, and the fight goes back many years. That matters because merchants do not love paying swipe fees, and politicians do not love systems that look too profitable. That does not mean Visa is broken. It means the moat is being tested. And that is what you ask with a company like this. Is the moat still widening? Is transaction growth still healthy? Is cross-border spending still strong? Are value-added services adding another layer of growth? And can the company keep growing earnings faster than the economy without inviting more pressure from regulators? So far, the answer from the quarter was mostly yes. The stock reaction made sense. Shares moved higher after hours because investors saw enough evidence that the core engine is working. Consumer spending did not collapse. International activity did not disappear. But here's where we have to be honest. Visa is not some hidden dirt cheap stock just because it pulled back. It is a compounder. You are not going to get it at a distressed valuation unless something is genuinely wrong. So the decision is not, is Visa a good business? That answer is obvious. The decision is, what return do you need? If you are modeling Visa with strong but not crazy growth, stable high margins, and a premium future multiple, then the stock can look decently interesting. Not screaming cheap, not back up the truck obvious, but interesting enough to study. And honestly, that is the right bucket. Decently interesting. Not emotional, not automatic. Just worth work. Now, Starbucks is a very different story. Visa is about scale, networks, transaction flow, and regulatory durability. Starbucks is about stores, service, labor, habit, frequency, and whether the product still feels worth the price. That is a totally different animal. and Starbucks gave the market evidence. From recent market updates, comparable store sales rose a bit over 6% globally, with transactions helping drive the result. Revenue was around $9.5 billion, up roughly high single digits. Adjusted earnings came in around 50 cents, above expectations that were sitting in the low 40s. The company also raised its full-year outlook for comparable sales and adjusted earnings. That is why the stock jumped after hours, because this was not just a small technical beat. It looked like the turnaround had some pulse. And that matters because Starbucks had become one of those companies where investors were tired of hearing the story. You know how this works. Management says traffic will improve, operations will get better, and customers will come back. And then quarter after quarter, investors wait. Eventually the market says, show me. This quarter, Starbucks showed. The CEO has been pushing the company back toward what made the brand work in the first place. Faster service, better in-store experience, more focus on the coffeehouse feel, and less of that sterile, rushed, mobile order chaos that made some locations feel like airport pickup counters. Now that is my wording, but you know exactly what I mean. A coffee brand cannot only be a caffeine distribution system. At a premium price, it needs to feel different. It needs habit, comfort, and a reason to beat cheaper coffee. And this is where the same-store sales number matters. If revenue rises only because prices go up, that is one thing. But if transactions improve too, that tells you customers are coming back. They are not just paying more. They are showing up. That is the turnaround heartbeat. But here is the counterpoint. Turnarounds are messy. One good quarter does not erase years of frustration. Starbucks is spending more on labor, store improvements, speed, staffing, and experience. Those things can help the brand, but they can also pressure margins. In fact, recent numbers showed North American margin pressure, even while overall adjusted margin improved. So when people say, look, earnings beat, everything is fixed, I would slow down a little. Maybe the turnaround is working, but maybe some of the improvement is coming with higher costs that take time to digest. That is the part investors have to watch. A restaurant or coffee chain can grow sales and still disappoint shareholders if the extra sales require too much extra labor, too much discounting, too much renovation, or too much operational complexity. So with Starbucks, I would not just ask, did sales grow? I would ask, did the business become easier to run? That is the real test. Because Starbucks already has the brand, it already has the locations, it already has the morning routine. The question is whether the company can turn that huge footprint back into reliable profit growth without making the store experience worse. And then there is China. Starbucks has moved into a structure where a local partner now holds a majority stake in the China retail operations, while Starbucks keeps a minority interest and continues to own and license the brand. The joint venture includes roughly 8,000 coffee houses today, with a long-term ambition that is much bigger. The idea is simple enough. Local competition is fierce, consumer behavior is different, and a partner with better local execution can sometimes move faster than a foreign giant running everything from outside. That could help, but it is not magic. China can be a growth engine, but it can also be a margin headache. Local coffee chains are aggressive, prices can be lower, consumer tastes can shift quickly. So if you are buying Starbucks because of China, you need to be honest about the risk. This is not the old world where every Western brand wins by opening more stores. Now let's bring this back to the investment side. With Visa, you are evaluating a high-margin toll road on global commerce. With Starbucks, you are evaluating a premium consumer habit, trying to repair its operating rhythm. Those are quality businesses, but not in the same way. Visa's quality shows up in margins, cash flow, network effects, and low capital intensity. Starbucks' quality shows up in brand, customer routine, store density, and the ability to sell a daily product at a premium. One is cleaner, the other might have more turnaround upside. But upside with more moving parts is still more moving parts. So how would I think about valuation? For Visa, I would use a range. Always use a range. Anyone giving you one precise number for a business 10 years out is pretending to be more certain than they are. I would assume revenue growth slows from this unusually strong quarter but stays healthy. I would assume margins remain elite, but I would not assume they expand forever. I would assume the company keeps buying back stock, but I would not let that become the whole thesis. And I would demand a return that actually compensates me for individual stock risk. Under that kind of framework, Visa can still make sense at the right price. Not because it is thrilling, because it is durable. And sometimes durability is underrated because it is not exciting on a screen. Now for Starbucks, the valuation is more sensitive. Small changes in sales growth, margins, and future multiples can swing the answer pretty dramatically. If you believe comparable sales can stay strong, if you believe the CEO can bring back better service without destroying margins, and if you believe the brand deserves a premium multiple, then Starbucks may look attractive. But if you assume growth cools, labor costs stay heavy, and the market stops rewarding the stock like an old premium compounder, then the return can look pretty ordinary. That is why I would not put Starbucks in the same bucket as Visa. Visa is a quality business at a maybe reasonable price. Starbucks is a turnaround business with quality characteristics. Those sound similar. They are not. One is proving strength, the other is trying to prove recovery, and the market reacts differently to those. That is why after-hours moves can mislead you. A stock jumping 5% feels like validation, but after-hours trading is thin, emotional, and usually focused on the first layer of the report. The real test comes after analysts digest the call, update models, listen to guidance, and decide whether the story actually changed. So I would not chase either stock just because it popped. I would study the report, write down the thesis, and ask what would make me wrong. For Visa, what would make me wrong is a real slowdown in consumer spending, weakening cross-border activity, more aggressive regulation, or new payment rails eating into its economics faster than expected. And yes, stablecoins are worth watching here, not because they automatically kill Visa. That is too simplistic. But because payment networks are evolving, money is becoming more programmable, merchants want lower costs, and technology keeps trying to remove friction. Visa is not sitting still, but neither is the rest of the world. For Starbucks, what would make me wrong is a turnaround that looks good for one quarter, but fails to sustain traffic, fails to improve service, or improve sales while keeping margins stuck. That is how you stay grounded, because earnings season is designed to make you emotional. Green candles, red candles, headlines, reactions, upgrades, downgrades, everybody yelling. Ignore most of it. Focus on the machine. Visa's machine still looks strong. Starbucks' machine looks like it may be starting to repair itself. That is the cleanest way to say it. Now, if you are successful, share your success story in the comments so others can stay motivated. People need to see that disciplined investing is not about guessing every earnings reaction. It is about building a process, staying patient, and not letting one headline push you into a bad decision. And before we wrap, remember, there are more major earnings coming from the big technology platforms, consumer names, restaurants, and some very controversial high-growth stocks. That means the next few days can shift sentiment quickly, so do not anchor your whole view of the market on one evening. Visa and Starbucks gave investors useful signals but not final answers. Visa said, the payments engine is still running. Starbucks said, the turnaround may finally have some traction. Now it is on investors to decide what price makes that worth owning. And that is the whole game. Not just finding good companies at prices that still leave room for reality to be imperfect, because reality is always imperfect. That is why you need a range, a margin of safety, and a clear reason for owning what you own. If your thesis cannot survive 1 weak quarter, it is probably not a thesis. It is probably just hope wearing a nice little suit. If you enjoyed this breakdown, subscribe for more earnings and market analysis. Keep your process simple. Keep your assumptions honest, and do not confuse a stock pop with a finished thesis. And just to be clear, none of this is financial advice. I am sharing how I would think through the businesses, the risks, and the valuation questions for education only. Your money, goals, risk tolerance, and timeline are yours. So do the work, check the numbers, and make decisions that fit your plan.